Okay, we're gonna get started. Today we're in for a real treat. We have the largest fund manager on the in the universe, BlackRock, and we have Jasmine Fan who's going to go through what's happening today. How do we navigate the markets? Just so much. Just the presentation is spectacular. I've been able to see it, and she's going to be phenomenal. I'm really appreciative of having her on today. And as we think about total wealth management, from risk management, insurance, and tax planning, we just got through April 15th. Um, how are we allocating the dollars? What's happening? How are we making best use of them? How do we navigate these challenging times? All of these things matter. So without further ado, I told Jasmine I'm gonna give her plenty of time. So this is going to go as for the folks who have been on here for many, many times. They know there'll be a 30-minute or so presentation. I would say on this one, take notes for sure. And then at the end of this, we're going to leave time for, I would say, at least 10 minutes for question and answers. So if you have any questions, put them in the chat. I will see them, and we're going to get to as many of them as possible. And if you're having questions about just anything that deals with investments, and we have Jasmine here, this is one to certainly ask. Put the question in the chat. Okay, without further ado, Jasmine Fan, thank you.
First of all, I just want to say thank you so much for having me here, and I'm very excited to spend the next 30 to 60 minutes with you to really go over what has been happening in the market. With that, I'm going to share my screen really quickly. It might take a couple of seconds for you to see, but we love giving out this student of the market presentation, especially during the periods where there are a bit more volatility than expected, right? Um, and this is a month that I would say this is particularly true, given the amount of headline news that you have seen over the past 30 days. But we want to really help you to focus on what really matters and what markets are actually telling us. Um, in the past couple months, investors have already been dealing with rising geopolitical tensions, an election year where there is usually associated uncertainty, and also just a noticeable pickup in noises that we're seeing from an investing perspective. So today's goal, for me and for everyone, is to really simply separate the noise from the market signals, and also looking at historical evidence to understand what this environment actually mean for portfolios at the moment and also going forward. So quickly, what we will go through during today's discussion. First of all, we want to start talking about the geopolitical uncertainty, obviously very top of mind for everyone, but we also want to look at how historically those events usually behaved, or markets behaved around those major events, what we have learned from those historical contexts. And then we will look at historical market drawdowns and to see what history really says about this type of recovery that we just experienced in the past 10 days. I would also want to update you on volatility, my favorite 2% trading day stat. Also, I'll take you to the midterm election analysis to see what we can expect, as we are getting closer to the November event. Um, I will also talk about earnings. I'll talk about international investing opportunities and also alternative asset class returns that we have seen in 2026. So a lot to unpack, but I want to jump right into it. So on the page in front of you, I know a lot of text and a lot of data, but essentially what we're looking at here is historical returns around geopolitical events. On the left, the very first column, you're looking at the most important or the most market impact events that we have listed. And not only we listed the 3 month before and after returns for each asset class, we also looked at the 1 year forward. What I can tell you based on this analysis is that most of the case, I would say 80% of the time, markets actually recover quite fairly quickly, right? Except for, sometimes those geopolitical events overlap with an actual recessionary period in US economy. But other than that, we actually see pretty rapid recovery. So, when during the month of March, when a lot of people were worried, were nervous, we knew that market would, take some time to digest the exact impact from an inflation perspective, from supply chain perspective, but eventually we would expect and recovery based on historical data. And I have to say, this time around, the recovery actually happened faster and quicker than I expected. And I do think there is a psychology or psychological aspect in that a lot of investors got trained really, really well by COVID and by the tariff episode last year. People knew that, this can be a really great opportunity to actually put more cash to work. So, you just have an earlier group of investors who are doing that compared to the historical evidence that I'm showing on the page here. But more specifically on what's going on in Middle East, obviously we're still seeing a lot of uncertainty in the region. Most importantly, there is still real supply chain impact in that there is still very, very light traffic going through the Strait of Hormuz, but the market is looking at a more benign outcome as we do see both parties, both US and Iran, willing to extend the ceasefire, willing to extend the truce so that they can actually go on and spend more time negotiating with each other. So the worst of that conflict has already passed. But that's not to say that we're going to see an easy resolution. In the near term, I do think there's still going to be some blockage in the Strait of Hormuz, but it is improving from a rate of change perspective. So that's why the market is, looking at a more optimistic perspective and had rebounded fairly quickly. And later on, I'll touch on valuation, which is another important factor in this most recent recovery. But again, we have learned from history is that it pays for us to stay invested, to not miss out on this type of big rallies. When it happens, it can happen much quicker than expected. The other really interesting analysis I want to bring to your attention on the page here is really the drawdown analysis. What we're looking at is really based on the worst drawdown during the course of the year, what the rest of the calendar year return would look like.
Hey
Um,
Jasmine, just
yes,
for everyone to understand, when you say drawdown, can you let us know
yes.
what you
It's
mean?
it's really just how much the market falls from beginning of the year. So using Iran or the recent event as an example, the worst drawdown we were seeing was about 9%. So end of March, when you look at broader US equity performance, it was 9% lower than where it was at the beginning of the year. And basically, the drawdown column we're showing here is the worst, um, you know, decline in that calendar year. Where's kind of the bottom of the market for that particular calendar year. So for 2026 so far, 9% is the bottom that we're looking at. And historically, what this means is that we're more likely to end up with a very positive return for 2026 than not. Because historically, when you do not have a worst drawdown of more than 15%, you actually end up most likely with a positive year. Of stock market return. And again, I think looking at this table, I'm also, and my takeaway is that it is very rewarding to invest in US equities because you actually most of the time have positive returns. This is 100 years of history. But again, 9% is not bad compared to other drawdowns we have seen throughout the year. But again, the worst drawdown is not the same as calendar year drawdown in that we do see recovery happening throughout the year, as we go. So again, this data tells us that we are still looking at, a pretty optimistic picture for 2026 from an equity market return perspective. The other interesting angle we can look at it is from a volatility perspective. And then the way we measure volatility is a bit different, but I also think this is very easy to understand, which is simply how many days of the year that we have more than 2% drawdowns, or we have more than 2% increase, right? When you pay attention to daily market performance, whenever you have you know, 2.5% of a gain, 3% of a gain, that's rare and, doesn't happen that much, especially in the most recent history. But what I want to actually note here is that in the most recent 5 years, post-COVID, we actually haven't had a lot of days where there are more than 2% of a gain or more than 2% of a drawdown, compared to maybe 2020. Sorry, 2008, we actually had 72 days where there are that much of a daily market move. And again, to remind everyone, there are only 252 trading days in a year, which means that back in 2008, there is a really large market volatility day every 3 or 4 days, whereas in the past 5 years, we have not seen that. Most importantly, you might feel like in the month of April and March, you had a lot of volatility in the market, given headline news is giving us a lot of shocks, both mentally and from an investing perspective. But in reality, we actually don't have that much volatility. Even in March, we didn't have that many days that we had more than 2% of a drawdown. So this is super meaningful just from navigating the market perspective, because on the right side of the screen, you can see that most of the time when you don't have more than 10 trading days where you have drastic up and down movements, the average return for those years are actually quite positive. 19.9%, high double digit. So, we really favor the environment where there isn't a lot of volatility because, lack of volatility sometimes is telling us there is a lot of good things to think about. There's not a lot to be worried about, and there is no lack of direction in that market. So again, in 2026, we're still sitting a pretty benign environment, even though if you just focus on TV, on headline news, you might not have the same takeaway. So
So Jasmine, you are it seems the outlook for 2026 is actually pretty bullish.
Yes, I can spend a bit more time talking about why we're still having a pretty constructive view on US equities. And I think actually this is a great segue to the next topic, which is earnings. Right? Earnings is really the key behind such strength we saw in US equities, right? US, compared to many, many other countries in the world, is the country that has the strongest corporate, capability, or, we see the strongest earnings results from US companies compared to others. Maybe not every year, but on average, that has been the case. We have the highest quality companies in those country in this country compared to other international regions. When you look at earnings growth for SP 500, we're looking at a 14% growth for the next 12 months. And this is actually the sixth consecutive quarter where we see high double-digit earnings growth for SP 500. And that doesn't happen that frequently. So this is a great environment that we are enjoying that strong earnings growth from US. And why is that? Why are we seeing such strong earnings growth? There is a lot of resiliency in US economy. Maybe your personal experience is different, but when you look at the broader macro picture, consumption and macro growth is still pretty solid. But the most important aspect here is really AI-led earnings growth. Obviously, there are a lot of technology companies that are benefiting directly from AI, but even outside of that, there are so much investments that are associated with AI capex and AI investments, um, and um, and there is just really money that are heading into different parts of the economy. For example, building newer power grid, building infrastructure for AI data center. So it's not just benefiting technology companies, it's really benefiting a broader set of the economy. And that's why we have seen that strength of earnings growth since the release of ChatGPT in end of 2020. 22. But as we see stronger and more advanced models of AI, there is even more of that continued growth that we're seeing in U.S. equities. And here's a very important point in that we actually saw valuation coming down significantly in the month of March because earnings have been upgraded this whole time given the strength in AI, but prices came down during the month of March, right? 9%, from um, the beginning of the year to the end of March, which just means valuations became very, very attractive. And valuation is measured by the ratio between price and earnings. And my, favorite example is that the valuation ratio for NVIDIA is actually lower than that ratio for McDonald's, right? Usually you do have very, very high valuations for technology companies to reflect that strong growth in the industry, and you don't have as strong or that as high of a valuation for a restaurant brand. And that just really shows you how cheap or how attractive technology companies are valued at this point. So again, we still see a lot of opportunities in US equities in investing in AI related themes, not just limited to the largest AI companies in the world, but also related themes like AI power infrastructure, like data center build out. So
So for people who feel like they've missed out on the AI boom, what you're showing here and what you're saying is that because of the recent pullbacks, this is an opportunity to buy at a lower valuation.
exactly, exactly. And then the other interesting thing that's happening is that we actually have seen quite a different shift in how people invest in AI, right? In the past 3 years, I'm not sure about, maybe, someone of you is an advanced AI user, but I've been really just using AI as my like chat box tool or like, get answers from, make my writing better, make my email better. But in 2026, we actually saw a foundational change in how people use AI with the success of Anthropic's cloud and co-work, right? I actually see more use case of people changing their workflow or, making their life a lot more efficient with AI and making their work a lot more efficient with AI. I actually just met with a family office client from Brazil this morning, and he was showing me he actually downloaded his DNA data and asked AI to like really identify and give him some health advice, right? So there are more opportunities and more ways people are using AI, but this also tells you that people don't have to pay software companies as much or services companies as much. I after hearing the DNA example, I'm like, why did I pay 23andMe, to get the health data, right? I can just use AI for the same exact, services. Another example is that you don't need to pay TurboTax. Anymore because you can use AI to do a lot of that tax analysis. Not to say that I'm going to do it this year. I didn't trust AI enough this year, but the direction of travel is that people can vibe code and generate a lot of AI usage, and they don't have to pay software services company the same. And there has been a rotation happening in technology investing from software to hardware because we will need more power, we need more compute, we need more chips. We don't need as many software companies in this economy. So with that, fast changing innovation, I do think there are always going to be opportunities in AI. But most importantly, I think large cap, U.S. stocks as a large group is where you can really get a lot of that AI derivatives beneficiaries. So there are just a lot of opportunities if you stay invested in this market. Feel free to, through any questions in the chat box, or, we can have some time towards the end. I'm going to move on to the next topic, which is midterm elections. This is usually a period where people get a bit more nervous. Why is that? Because if you look at historical return during midterm election years versus all other time, you do have lower returns, like meaningful lower returns on average compared to non-midterm election years. And I have seen some data around how, election years is actually where you get amazing return, especially after the uncertainty was taken out. But midterm election is where you just have so much uncertainty that the first 3 quarters on average doesn't give you that much. Um, and for so far, like if you just look at Q1 year to date, that's pretty accurate still, right? So again, it shows you the power of those historical analysis. Um, but I think this is important, that the last quarter of election years actually give you higher return than average, 60.7% versus 3.9%. That is truly meaningful. And what this is telling me is that people are a little bit scared in the first half of the year or before elections, that they do not really want to bet on a lot of sector opportunities. Whereas after midterm election, after the uncertainty is removed from the near-term horizon, they actually love putting money back. And on the right side of the page, you can see how much return you usually get right after midterm elections. So if history repeats itself, what we are expecting is a strong 2026, but with a lot of performance concentrated in that last quarter or maybe like a little bit after the summer. is
Yeah,
what
yeah.
we.
I'd be curious to know, Jasmine, will that be because people know the direction of where who's gonna typically win in that fourth quarter? You
Yeah,
have
yeah.
now we know if the House or the Senate's gonna change.
100%. That's a good, really good point. I think, really, we saw a lot of impact from the Middle East conflict on domestic politics. So we kind of know, or like we have a bit of certainty around some of the state, for certain state, kind of, we have more information. I would say there's not full certainty yet. So people are still going to wait. But given how much of a near-term impact we have already seen on domestic politics, I would say maybe we get that Q4 performance a bit earlier this year because people are probably going to start again buying the dip or start adding money back earlier, just what we saw post Middle East conflict. Um, Great. And moving on, I just want to talk about a very interesting analysis that we, always do, which is looking at the broadening out to asset class returns in 2026. This is really the percentage of asset classes that lose money in a given year. And we're defining asset classes using the Morningstar category average, which there are a lot of, over 120 so far this year. Um, and return have actually been more constrained, meaning really fewer categories are actually posting positive gains this year. And again, this is as of end of March, so this is, very much at the bottom of Middle East conflict. The data might look much better now. Um, but at the bottom of that sell-off, 57% of categories actually lost money. However, where we have seen a lot of help is actually in alternatives and commodity categories. And I'm not surprised by that, given how commodities were actually the problem of this conflict, or or where we are seeing positive returns. But this is a bit of a reversal of 23 to 25, where you actually don't have that many categories that are losing money given the calendar year. So again, this data has to be updated. Now the market had rallied back, but again, it's interesting to look at from a broader asset class level what's happening. And on that topic, I want to also talk about international, right? I love international investing because I am from China and I just see a lot of interesting opportunities outside of the US. But what I've noticed is that US investors have this home country bias, which I don't think is wrong given how amazing US equity returns have been over the past 3 decades versus international. But I do think it's important to point out whenever there is an opportunity in international markets like 2025 and 2026, we actually saw a performance of international. A lot of that was driven by the dollar last year, right? The dollar had weakened roughly 10%, and that sort of continued into 26. And that is really bad news for anyone who is planning an international vacation this summer, right? It's just a bit more expensive, especially if you're going to Europe or certain Latin American countries. But it is really helping international equity returns in a major way. But the story in 2026 is more than just the dollar. You actually have a big AI investing story in international markets. When you think about the hardware component of international AI investing, 75% of semiconductor manufacturing happen outside of the US. So emerging market Asia is where the semiconductor production actually happens, and there is so much opportunities in South Korea, in Taiwan, in Japan, where you have companies that are actually are the suppliers of US AI. And Latin America had benefited as well because they're the producers of copper, of commodities that are going to be used for the power stations for data center build out. So we do like international opportunities in 2026. Um, and this is a really unique environment where U.S. Concentration is becoming more of a concern, whereas you know and whereas in the international markets you sort of see that diversification happening.
So another question, since I would say since the pandemic, the S&P and US markets have just outperformed international markets pretty dramatically. Um, do you think there a some type of correlation between and so therefore US stocks were valued higher, the valuations change. So there's more of a value in international stocks. Is there a certain time frame, like after 3 or 4 years of continuous outperformance from US markets, that it's a good time to really look at or look into maybe emerging markets or just international developed markets?
Yeah, I wouldn't say there are usually historical time periods because I think every decade has been very, very different. Between 2000 and 2010, international did really well because of the commodity super cycle, because of the China story. And then it reversed in the 2010s. Um, again led by that strong growth in US equities. And since COVID, I would say there is even more opportunities in international given AI. So there isn't, I would say a pattern, but because there are so many different drivers, unique drivers for international outperformance across historical periods. But again, I think as you mentioned, what I would pay attention to is really valuation. International is actually becoming more attractive after the strong AI-led growth in South Korea, in Brazil. So we really like emerging markets in international, whereas we also find US equities attractive, right? Valuation is also not bad for US. So this is a time I would say I would really like to own both. It's not either or. It's really about having some additional emerging market exposures to complement the US exposure, especially if you believe AI is going to be a long-term driver.
Okay, got it.
And then one of the last slides here is really about income and how you can boost that part of portfolio. We are in a quite different environment today versus 21, 22, right after COVID. Risk-free rate was actually very high in that you don't have to really invest that much. You can just ride on that risk-free rate. Whereas today, that policy rates or the cash yield you can get is much lower, and that just you really speaks to the importance of owning income and as a protection in your portfolio or as an income source
So
in
Jasmine, let
yeah.
me ask you the question. And just for those who are listening, I told Jasmine I'm going to be cutting her off a few times in
Oh
this
yeah, yeah,
presentation.
please,
So,
love that.
um, but when you say fixed income, for those who may not know, what are you referring to?
Yeah, so I do think that it's important to clarify that there is a difference between fixed income versus income, right? I think income is a bit easier to understand, which is, a stream of cash flow that you're getting from investing or from something else, right? And in this case, we're just talking about investments, and it's a regular payout. And there are many different ways you can get income from. And when we say fixed income as an asset class, we're just talking about bonds. Right, that type of paper contract, and that type of loan specifically. However, there are many, many other ways you can get income. For example, dividend stocks, they pay pretty high or pretty decent income. And then there are more alternative vehicles or, ETFs, products that can offer you attractive income. So when I say income here on this slide, I'm more talking about broader income. Whereas, some of the bond index here we're showing is more specific fixed income that, as an asset class. Again, what we're showing here is that, it really helps to have more income sources in a portfolio or more alternative exposures in a portfolio to provide that downside protection. And March is an example in that, a lot of things didn't work. Like gold didn't really work in March because it was an inflationary shock, whereas the alternative asset classes, or the exposures that are less correlated with your regular bond and stock exposures actually delivered in the month of March. So it is very important to have that, an important diversification or diversifier in a portfolio. With that, I'm going to end back on this page to really summarize what we have been talking about today. Right, we started by talking about geopolitical volatility and to show really how historically, markets quickly absorb this type of shock, and people are usually rewarded by staying invested amid macro uncertainty. And also we show the 2% analysis to show how this year actually hasn't been that volatile. In that, we are pretty constructive in a year where there isn't that many days that you get more than 2% up or down type of movement. And also we talk about the election, right? You midterm election in that we can expect a pretty positive Q4, but some near-term volatility based on historical analysis. And lastly, we talked about the opportunities we see in 2026. U.S. equities, international equities, given the strong AI-led earnings growth, but also thinking about income, thinking about alternatives as a way to generate that portfolio protection. Um, I know there might be some questions, but I want to
Yes.
pause here and see, what else, you have a question on, or
Yes.
anything you want to spend.
Yes.
I'm happy to dive more into any of those topics.
So thank you, Jasmine. So I'll say this is fascinating to go through that. If you're watching if you watch the news as early as or as late as last week, um, and there with the war going on, we don't know when it's going to end, and there was a gloom and doom mindset when you watch some of these stations, and you hear maybe the rhetoric of our administration, and people going back and forth to really allow people to have a lack of confidence in the market and get away from the facts. And looking at the data that you just provided, if you looking historically, it shows us, in fact, this is a time to get in. So move the noise out of the way. And because of those emotions, I mean, Warren Buffett said it all the time. That's how people lose money in the market. That's why people don't win. Um, so the first question we have here would be, what's a good strategy as we look over the next 6 to 12 months? What's a good strategy to look on how to invest? The second part of this It's when the news is bad and not great, like it's been I would say 2, 3 weeks ago. What should we be thinking about then as well?
100%. First of all, I want to say, I spent a lot of time talking about how much AI is driving growth in the US and also globally, and also just in our day-to-day lives. You probably have already seen the impact of AI as a structural force. So in the next 12 months and even in the next 3 to 5 years, I still think the best way to get closer to the AI theme is by investing in large cap growth US equities. And again, if you want to be more specific on AI, we have a lot of AI supply chain focused products and ETFs that you can choose from to just invest in AI. But from an overall portfolio perspective, having that overweight in large cap growth is going to be great, or give you that access to the amount of innovation we're seeing, or the amount of changes that we're seeing from AI. And then I think it is usually very normal to panic a little bit or to worry a little bit when there is a lot of market uncertainty. And in the case of March, not only we're seeing market uncertainty, we saw so many negative news from Middle East, especially if you have families in the region, or if you have business ties in the region. This is really impacting a lot of people from a personal life perspective. So there is a bit more of a bearish sentiment. I think that's a great time to look back on some of those historical data to show that how quickly market rebounded after Russia, Ukraine, how quickly market rebounded after 911. Again, not to say that investors are ignoring the actual physical impact, or ignoring what's going on in the world, but it's more the fact that the market trades ahead of the physical world, and you're really trading the 26, 27 earnings. You're not really stuck at what's happening in the month. So it's important to look at historical analysis and really look ahead to see what the market is, where the market is at the moment.
I'm on pause. I'm on mute there. So what you're saying is the news is bad today, for instance, let's just say that's the case, and stocks are down pretty drastically. If I think that there's going to be some type of government intervention, or the markets will change within the next 12 months, this might be a good time for me to actually not just even rebalance the portfolio, but possibly put more money in with an expectation that markets should recover over that period of time, if that's the belief.
100%. And again, looking at historical experience, right? The other aspect of this is that, when you look at the actual impact from supply chain shock in Middle East, US as a country is less impacted, or is more isolated from the amount of energy and supply shock, or the shock from other key industrial materials compared to economies in Asia. So Americas as a region, I wouldn't say had benefited from the recent event, but it is less isolated, or so it's more isolated and less impacted. That's why, when you look at earnings data, right, you actually don't see as much of an downgrade from Middle East because there isn't that much of impact. Obviously, energy prices are much higher compared to where it was a couple months ago. But we're not in the situation where daily production, or overall consumption had been so negatively impacted. I think that's the other reason U.S. market participants were able to look over this quicker than other parts of the world.
Got it. Got it. Um, Another question, and we've got several here. Um, when we think about again watching the news, you hear that people are going to be losing jobs. In fact, I read that 5% of all jobs have already been replaced by AI. Um, how do we think this is going to affect our economy, and how do we, in the short term, how do we feel that this is going to um, affect the markets?
Yeah, that's a great question. I would say this is not only the question that we're getting from clients on a day-to-day basis, but also uh, it's a question I'm having with my friends at dinner table. Like, just it's really hard to get away from the conversation without talking about AI. At the moment, when we look at US jobs data, right, we haven't really seen impact in labor market coming from AI. There isn't mass layoff as a lot of people kind of predicted, right? Not to say that we're not going to see it, but it's happening very, very slowly in that we are not really seeing that impact on the overall jobs market. That said, when you divide jobs by professional, by industry, what's actually happening is that the white collar jobs are declining, right? Because AI can replace a lot of the office workers, right? Whereas the blue collar job is increasing because that big demand for healthcare professionals that cannot be replaced by AI. So you have that divergence in the jobs data that we're looking at, but not a moment to really panic about AI-led job loss yet. Overall, what we're seeing, looking at, a lot of CEOs and company owners talking about AI, I think it's really about making job markets or job workflows more efficient, less about to replace human beings entirely. At least I don't think AI is that smart to replace all the professionals that we have. And in my day to day, I fingers crossed, AI is not going to be that smart to replace me in the next 2 years. But AI had benefited me in my day to day. So I think it's a really going to be a period of skill set training or retraining to make sure we can all use AI. But I don't think there is going to be massive job loss because of AI. I think it's just more about repurposing the function, getting a bit more advanced in what we do.
I agree with that. It's to speed things up, which expands the economy, right? If that happens. So I agree with you there. Um, so I've got a two-part question here. Um, what, and so with the war going on, what markets should we avoid? And from a someone else, what areas are we overlooking right now? Because all we hear is technology, AI.
Yep.
Um, so what areas should we avoid, and then what areas should we be looking toward right
Yeah, yeah, that's a great question. So as I mentioned, if you just look at the real supply chain shock, right,
now?
the economies that are going to be more impacted from a day-to-day perspective, from a individual consumption perspective, is emerging market Asia, Vietnam, Indonesia. And luckily, I think most people don't actually have stock exposures to those regions. And it also has a pretty meaningful impact on South Korea and Taiwan, given that they do get more than half of their energy resources from the Strait of Hormuz. But two things are helping. One is that they're able to almost reroute some of that energy supply chain or get some additional energy from Russia as kind of a result of this current conflict. But also both countries or both regions are so heavily concentrated in technology in that you actually don't see the current supply chain shock impacting technology valuation or earnings. That's why you actually don't see a big price impact in South Korean stocks or Taiwanese stocks after the rebound. Obviously, in March there's a bit more of panic and price impact, but they have mostly recovered because of that strong tech earnings. So again, avoid regions where there is a bit more of that uncertainty. Middle East, as an example here, but there is less of that impact if there's a technology concentration. That said, I don't think technology is the only place we should be looking at. I still believe AI is going to drive a lot of the growth we're seeing, but it's less so in technology sector. We
If you had to pick one other option, one other sector in the market
Yes.
to look that's being overlooked, which one would that
Yeah, yeah. I wouldn't say I'll give two examples. One,
be?
that's I wouldn't say overlooked because the sector I was gonna say is aerospace and defense. So very much center of the story, right? But the difference between aerospace and defense from 10 years ago to today is that there's a big technology component of aerospace and defense. Palantir is such place, and so OPIC played such an important role in Middle East and in Venezuela. So there is that kind of renewed definition of what's aerospace and defense. The other sector I think people have not paid as much attention to is healthcare.
Mm,
One is that, with global aging, you just will need, there will be a lot more demand for healthcare as an industry, as a sector. But at the same time, we're seeing selected industries within healthcare benefiting from AI. For example, biotech, pharmaceuticals, right? They are leveraging AI to, get to the next pipeline much, much faster and, is kind of seeing a bit of a cost cut even. Just to flag that as an opportunity, even though it's not AI directly, I would say it's an AI adopter story.
okay. Okay. Thank you. We've got time for two more questions, and so we're going to miss a few of these. Jasmine, you've been wonderful. So one question is, what type of cash buffer would you recommend in keeping in a portfolio? This is more of a wealth management question, but I'm going to rephrase that a little bit, Jasmine, for you. What are the effects of inflation for someone who's pretty cash heavy, nervous, watching the news, keeping a bunch of cash in the bank? Is that a good thing or not so good right now?
Absolutely something we would not recommend, given the yield you're getting on cash is just much lower, right? And also with the direction of earnings growth, of resilience in U.S. economy, it's a bit hard to see another drawdown in front of us for you to really put all of your cash back into the market. And people are really buying the dip in a way that the dips are becoming much more shallow compared to, let's say, like 2008 or 2020. So it's a bit hard for that, I'm gonna have a lot of cash and put it all at once when there is a big recession type of scenario, at least like not something we expect in the next 2 years. Therefore, we do think it's important to put cash to use, either by putting it into higher yielding bond like allocations, where you can actually take out or reallocate flexibly. And also we have a type of ETFs that are actually called buffer, in that there are ETFs with optionality that can actually give you an upper bound or a lower bound to kind of protect you in equity markets as you like, and we can obviously have a different conversation about that. But just want to point out that there are more tools for investors to leverage in today's world, so that cash is no longer kind of the best alternative people have.
because you can have upside potential but still have downside protection. I think that is incredible. And just for the very last question, which goes in line with the previous question about inflation, where are we thinking interest rates are going to go, and how should we navigate that?
Yeah, 100%. Just to provide a bit context around this, right? Earlier this year, before this Middle East conflict, we were looking at 2 to 3 cuts by the end of the year. And again, this is because labor market is slowing down, and I said there's a lot of resilience in the U.S. economy, but it's cooling down from where it was, so that we don't need this much of elevated, policy rate to play. However, Middle East had actually gave us an inflationary shock in that the energy related inflation is real, or at least will be, actually a couple more questions, last for a couple more months. Uh, that doesn't really derail the overall trend of US inflation, in that the overall trend of inflation is downward looking. So we think the next move is still going to be a cut, then a hike. It's just that we might not get 2 cuts this year. It might be 1 cut, and it might happen much later in the year. But again, what's important is that it's going to be a cut, and that means the cash yield is going to be lower. And going back to something we have emphasized on this call, which is that we want alternative ways to put cash to work, so that you're not missing out on that return by holding cash.
Wonderful, wonderful. So if we can take this slide down and put up the work slide. Um, this has been truly phenomenal. I've learned some things. This is this it's all about mindset and looking at the facts and the data so you can move forward efficiently. You're waiting, you're watching the news, you're hearing the headlines. Of course, that's what they're there for, to get clicks, and to get eyeballs, to get your attention. And typically bad news is something that can draw that. But when you look at the data, that BlackRock, that Jasmine has put together to show us, it really paints a different story. And instead of being defeated, I'm certainly more excited um, about the future as well. So thank you for your time. Thank you for attending. If you have any questions for us, you can take a picture of the link, let us know, and then we'll also make this one available for you to be able to see. So thank you so much. Thank you, Jasmine. Everybody have a great day.